Hello, I'm Edmund Parker. I'm Global Co-Head of Derivatives and Structured Products at Mayer Brown. I'm also the author of this book, Credit Derivatives, Documenting and Understanding Credit Derivatives Products, which I wrote and was published in autumn 2007. A lot's happened in the world of credit derivatives since that time, and a lot's happened to the ISDA credit derivative definitions, not least the Big Bang and Small Bang supplements, which were produced in 2009, and now the 2014 ISDA credit derivatives definitions, which will come into effect in September this year. I'm going to talk about today the evolution of credit derivatives over the period since I published my book in 2007, and what the changes are that are being brought in to the new 2014 ISDA credit derivatives definitions. I first started working on credit derivatives matters in the late 1990s. The industry had been running for just a few years at that point. Initially, credit derivatives had started to get momentum where banking institutions which held loans and bonds on their books were looking to isolate and separately trade credit protection on those assets. The industry had started to get some momentum, and in 1999, the ISDA credit derivatives definitions were published. As is often the way with the ISDA definitional booklets, these had quite a subjective element to them as the industry itself gained momentum. And as with all definitional booklets, they covered standard definitions, contractual terms, and fallbacks. Over the next 4 years, the definitions developed in response mainly to market events which could not have been predicted at the time. And a number of supplements were introduced to the 99 definitions. There was a supplement that was introduced for restructurings. There was a supplement introduced for convertible, exchangeable and accreting obligations. And there was a supplement that was introduced for successor provisions. The 3 supplements that were introduced responded to particular market events. One of these was the restructuring supplement, and that supplement responded to a market event that had happened in relation to a company called Conseco in the United States. Now, Conseco was a otherwise healthy company which had hit some cash flow issues, and so had restructured some of its debt. And the restructuring had involved having a shorter maturity on some of the securities, issuing guarantees on those securities, and altogether making a healthier security for the restructured securities. Now, the securities which were longer dated and had not been restructured were still out there in the market. So a credit event had occurred in relation to Conseco. It was a restructuring credit event. The majority of the market was physically settled at that time, and this resulted in the restructured securities trading at a higher price to the unrestructured securities. Following the credit event, various market counterparties which held the restructured securities went out, bought the cheaper securities and delivered them, a cheapest to deliver option. This caused something of a ruction at the time, and this was addressed in a restructuring supplement that introduced the concept of modified restructuring. This was the first indication of restructuring being the problem child of the credit events. The modified restructuring provision wasn't particularly popular in Europe. It didn't fit well with the debt markets that we had. And so when the 2003 definitions came out, this was added to with what was called modified restructuring, which allowed for securities which were delivered following a restructuring credit event to have characteristics which fitted with the European market. Similar problems had occurred in relation to the Railtrack credit event which had happened, which caused problems about whether certain convertible, exchangeable or accreting obligations were deliverable and at what price those deliverable securities should be assessed. This has been addressed in a convertible, exchangeable and accreting supplement. And finally, there had been some confusion about who a proper successor should be following a market event involving energy companies. And this had been addressed by a successor supplement which introduced a far more objective criteria to assessing who successors should be following a credit event. So these three supplements were wrapped up and added into the 2003 ISDA credit derivative definitions, which also introduced various other upgrades to the credit derivatives definitional infrastructure. The 2003 ISDA credit derivative definitions were introduced into the market in May 2003 with a supplement following very soon after to correct a minor issue that had been detected. And at the time, this was a big jump in sophistication in the definitional booklets. But various changes became necessary, once again, in response to market events. The 2003 definitions had allowed both physical and cash settlement of credit derivative transactions following a credit event. The cash settlement piece had not been particularly popular with the credit derivatives buy side. Cash settlement as it stood had required quotes from a number of market counterparties for the post-default trading price of a reference obligation, and there wasn't a great deal of confidence that this would be reflecting the actual price. So physical settlement remained the predominant way to settle credit derivative transactions. However, as the market grew, some names, some reference entity names traded in the market had a far greater volume of credit derivatives referencing them than actual debt that was issued. And in one particular market credit event, the post-default trading price of a defaulted reference obligation shot up as market counterparties, credit protection buyers who were trying to physically settle their trades, scrambled to try and purchase the defaulted reference obligation. The price of that reference obligation after the market settlement had occurred then plummeted back down to what should have been its proper trading price. This clearly was a situation that couldn't go on, and in 2009 we saw the Big Bang and the Small Bang protocols. These supplements allowed for a special regime to apply for credit event settlement, a halfway house between physical and cash settlement. What the supplements did, and let's take the Big Bang supplement first, was create a credit derivatives auction where those who were buying and selling the defaulted securities physically of a defaulted creditor, a defaulted reference entity, could trade within an auction. And the credit derivatives community would also look on under the auspices of ISDA and would calculate what the final price should be, having taken account of this physically settled auction. And the mechanism for doing that was set out in the Big Bang protocol, Big Bang supplement. Another supplement was added called the Small Bang supplement, and this looked at the restructuring credit event, where different prices could be determined depending on the different maturities of restructured defaulted obligations, which might be trading at different prices. So in this auction, for a restructuring credit event, the auction took a look at various buckets of different maturities of restructured obligations, priced those, and then that price was used for the cash settlement of all credit derivatives. Something else introduced by those changes had been to introduce the idea of a determinations committee, a committee of the great and the good of the credit derivatives world, which instead of relying on a bilateral arrangements that had existed in the past, allowed market counterparties to defer to the determinations of this determinations committee to establish, had a credit event occurred, and what particular prices might be involved. Fast forward 5 years and a lot's happened. Bearing in mind that the underlying asset of any credit derivative is a debt or loan obligation, a lot has happened in the debt or loan obligation market, particularly for sovereigns, looking at the restructuring in Greece, in Cyprus and other sovereigns, and the restructurings that have occurred in relation to the defaulted financial reference entities such as S&S, of Lehman, of all sorts of other banks that have been affected in the wave of the financial crisis. So the 2014 ISDA credit derivative definitions seek to wrap up the previous changes, the big bang and the small bang changes that happened in 2009, together with various changes to tidy up how the definitions work, to make them more objective, and to provide new infrastructure to deal with the situations that have been brought up in the financial crisis of the last few years. So I've got my work cut out now to update this book. The update I'm going to do is going to be an extract. I'm going to call it the 2014 ISDA credit derivatives definitions. And what I'm going to do is I'm going to strip out the 2/3 of this book, which covered the 2003 ISDA credit derivative definitions, and I'm going to update those so it reflects the new regime and details why those changes have occurred and what effects they have on the documentation. The first major change introduced for the 2014 ISDA credit derivative definitions is the introduction of a new credit event. This is the government intervention credit event. So the credit events that we had already under the 2003 definitions were bankruptcy, failure to pay, obligation acceleration, obligation default, repudiation and moratorium, and restructuring. And those 6 credit events remain. But the financial crisis, as it affected banks and financial institutions, revealed that there was a slight gap that arguably may not be caught. And this was where a financial institution was failed or was failing and its assets were expropriated by a government and possibly extinguished. A further change introduced in the 2014 definitions is the introduction of specific terms that apply to financial reference entities, which introduces a split between subordinated and senior debt. Now, for these provisions to apply, they have to be specifically selected in the confirmation, and that can be done through the incorporation by reference of the physical settlement matrix, which will apply financial reference entity terms through the matrix where the reference entity is a financial institution. And what the financial reference entity terms do is they look at the underlying debt of a financial reference entity and realize that not all debt may be treated the same following a credit event affecting that reference entity, and in particular that the senior debt and subordinated debt may not be treated the same. Where the financial reference entity terms apply, then the definitions will look through on a credit event to see whether subordinated debt and senior debt have both been affected. So if we had a credit event, a government intervention, which results in expropriation of subordinated debt, but the senior debt was left unaffected, not restructured or expropriated, then the credit event would only be deemed to apply to the subordinated debt, and the related settlement would only take place in that regard. For the senior debt to be affected by the credit event, then the senior debt would also need to be the subject of that intervention or another credit event. The financial reference entity terms are also affected where the successor provisions apply. Previously, And I remember setting out a very detailed table in my 2007 book as to how one would determine who a successor should be. There was no distinction between subordinated and senior debt. One only looked at the obligations of the successor. Where financial reference entity terms apply, where the subordinated debt remains with one entity or transfers to another entity, and it's the subordinated debt which is the reference obligation, the financial reference entity terms ensure that the successor will become the entity that maintains or has that subordinated debt. Another area which is new for the 2014 definitions is the introduction of assets package delivery provisions. And these asset package delivery provisions are designed to capture when no deliverable obligation exists anymore. And that could be because following a credit event or because of a credit event, the deliverable obligations or reference obligations have either been extinguished or exchanged for some other type of asset. And the new provisions that are introduced in the 2014 definitions allow the parties to look at what was there before the credit event occurred and what has it become. So if the assets have been extinguished, then there is deemed to be nothing and the final price is deemed to be zero. If instead the assets are changed into some other types of assets, then those are the assets which become deliverable. Various other changes are made throughout the new 2014 definitions as well. If you were to run a black line between the 2014 definitions and the 2003 definitions as they were updated in 2009 through big bang and small bang amendments, the changes look significant, and in many ways they are. But many of those changes involve moving provisions between different sections of the definitions, and we've looked at some of the principal changes such as government intervention, the new provisions for assets package delivery. There are also some tweaks to the successor language, which will allow a universal successor to be declared to be a successor, notwithstanding that any backstop date has passed. There are also some changes that are introduced in determining what a standard reference obligation should be, with the provisions for some ISDA standard lists, and some new fallback provisions for determining what substitute reference obligations should be, as well as now a much increased and enhanced provision for determining who a successor should be in the event that a sovereign state breaks up or amalgamates, something with the Scottish independence vote before us soon and various other international events happening has become much more relevant than back in 2003. There are also some amendments to the restructuring provisions and some tidy up provisions throughout. So in summary, the 2014 definitions are a substantial change from the original 2003 definitions, but we already had our revolution with the 2009 changes. Since 2009, we are having a catch up with responses to market events which could never have been foreseeable previously and have happened in the last 5 years. So the new definitions, the 2014 definitions, are much enhanced. They're longer, they're more sophisticated, and they're a great improvement on what ran previously, but they're a necessary evolution on that. The 2014 definitions come into effect in September, and I will be producing a number of these video blog and video lecture entries which will detail the provisions, the updates, and their effect and provide a greater understanding of those. Thank you very much.